Hello, everybody. This is Dave Gilreath from Sheaff Brock Investment Advisors. Remember, we are the firm that uses innovative portfolios for intelligent investors like you. So today is March 4th, the morning of March 4th. The market's down hard today. It was down hard yesterday. It's down about 5%, 6% from its peak. S&P 500, that is down that much. The NASDAQ is down like almost 10%, close to correction territory, as they call it. So people are getting very concerned about all kinds of things and not just stock market related. I'd like to share our screen real quick. We're going to show you a couple slides that you might find interesting and take it away from there. So the first slide here is Americans are concerned. And you're not alone if you're concerned. People are concerned about all kinds of things, tariffs, and there's a whole list of them you can see on the screen here, deportations and foreign policy and arguments in the Oval Office and executive orders and all kinds of things. The Policy Uncertainty Index, which has been calculated for decades now, right now you can see on the far right-hand side is we are the highest uncertainty index that has been ever since COVID, where it spiked up a little bit. But we're higher than we were in 2008, 2009, higher than the crash of 87. There's just a lot of uncertainty out there. And what's interesting on this chart anyway, these red dots and yellow dots are when there's been corrections and bear markets. And generally speaking, they've never started when people are super worried like they are right now. So we'll see if that holds the case this time. The public, though, investors are super concerned. Right now, 61% of American Association of Individual Investor members are very concerned, they're very bearish on the market. And that's the highest number in the last year, and it's actually the highest in many years. So, which we'll get to in a second. CEOs, though, and the stock market aren't that worried, it doesn't look like. CEOs just about 2 weeks ago were the most optimistic that they've been in 3 years. And the S&P 500 hit a new high just about, 10 days ago. And so the market is down a little bit, but you can see this correction here from the peak to where we are now is not unlike most other drawdowns of similar nature that goes back years and years and years. Sometimes they get a lot worse. Oftentimes they don't get much worse and they just bounce back again. So investors, though, who are very bearish, they've been this bearish only 6 times in history since 1987 when they started keeping track of all this stuff. And you can see, generally speaking, they've been bearish at the wrong time. They've been bearish at market bottoms, market lows. Now, not always. You can see here in 08, right before the big correction in 09, they got very bearish in 08, late 07, 08. And that was a correct time to be bearish. But other than that, it's been a pretty good contrarian indicator. There's 2 analysts that I follow that are really good, have been good for many, many years. One is Ed Yardeni, who we've quoted quite often. The other one is a company called Fundstrat, run by a guy named Tom Lee. Tom Lee, at the beginning of the year, was only looking for about a 10% move in the market. Ed Yardeni is looking for the S&P to go to 7,000 here, which would have been about a 15% move. Right now, the S&P is at about 5750, somewhere right around there. So I think both of these guys are probably going to be, I think it'll be okay unless, everything comes unglued. But it's very unlikely, in my opinion. One thing we worry about is let's buy good companies and let's hold them quite a while. And let's just buy the ones that are growing and let them continue to grow and compound for us. So this is our 3 portfolios: dividend growth, IntelliBuild, and outlier growth. And this is just from the spreadsheets we run every week on our portfolios. And I've shown here earnings per share year-over-year growth and revenue growth in the second column. And you can see every company on here has positive earnings growth, positive revenue growth going forward, according to the analysts for this year. Now, the average of our dividend growth portfolio is almost 12% revenue growth or earnings growth and 7% basically revenue growth. And you can see each portfolio gets a little bit more because it's more growth oriented. IntelliBuild is 13% and 10%, and outlier is 20% growth and 13% revenue growth. Now that compares the S&P 500 is at about 12 and 5. So all of our portfolios have higher revenue growth. Dividend growth has slightly lower earnings per share year over year, but our dividend yield is much higher. So we're very optimistic on the stocks that we own that they're going to have a reasonably good year when it all comes down to it. So basically, there's a lot of political stuff to worry about. Please remember that the politics, the economy, and the stock market are cousins, and they don't often talk to each other. They're kind of like, the cousins at Thanksgiving that you don't really get along with. Yeah, you're related, but you don't really talk to each other often very much. Individual investors, very bearish, and they've usually been bearish at the wrong time. The economy is doing pretty well. CEOs are optimistic. Best strategists in the business are still optimistic, and our equity portfolio holdings and revenue growth are quite solid. Thanks for joining us. We'll be back with you next time.